sale of loans, so on balance sheet growth in the loan book stands at 13%. The loan book in absolute rupee terms stood at 2,48,097 crores, which compares to 2,19,939 crores in December of last year, which represents a 13% growth. However, this is an on-balance sheet growth. The reality is that we sold a lot of loans. If we take the last 12 months, that in the calendar year 2015, we have sold loans aggregating in all to 12,975 crores. Had we not sold these loans, then the growth in the overall loan book would have gone up from 13% to 19%. Now, in our loan book, we have individual loans and we have non-individual loans. So let me first talk about individual loans. Individual loans on balance sheet growth stood at 14%, but all the loans, the full book of 12,975 crores that we sold, were all individual loans. So if you add back this 12,975 crores to the loan book, then the growth in the individual loan book would have been 23%. So overall loan book growth, adding back loans, would have been 19%. Individual loan book growth, adding back loans, would have been 23%. Now, when we sell a loan, we don't book profits upfront, the way we would be required to do whenever we adopt IFRS or US GAAP or whatever. So under Indian accounting norms, what we do is when we sell a loan, the difference between the interest rate at which the loan has been originated and the interest rate and the interest rate at which the loan is sold, that differential flows through to the profit and loss account on a yearly basis. So on 31st of December, we had a total book of 29,897 crores of rupees, or 29,987 crores, which have been sold by us and on which we earn a weighted average return of 1.21%. So we are earning income not just on the on-balance sheet outstanding loans, but we also earn income on loans which have been sold by us. So that was on the individual loan front. Now, if you look at the non-individual loan front, we've seen a growth in this current quarter. So if you have seen this financial year, the first quarter had actually negative growth in non-individuals. The second quarter had marginal growth in non-individual loans, but if you look at the first 6 months, April to September, we had actually a negative growth in the overall non-individual loan book. This quarter, however, in the month of December and more towards the latter part of the month, we have seen a growth in the non-individual loan book. So the growth in the non-individual loan book in the course of this quarter is 1,987 crores rupees. On this 1,987 crores, we have to make a provision for standard assets, as is required by our regulators, National Housing Bank, and that provision is to the tune of 1%. So there is a 1% upfront provision that we have to make in the P&L account in respect of the growth in the non-individual book. The income on the non-individual book will flow through in subsequent quarters, because just now it is just a disbursement made in December. It's really not earned much income. The income will flow through in future years, but the cost being the provision is taken upfront. If we look at the breakdown of the loan book between individuals and non-individuals in a 9-month period from April to December, 93% of the book has been on individual loans and 7% has been on non-individual loans. Whereas in September, when we were talking of these numbers, it was actually 101% individuals and non-individuals was negative 1%. So that has seen a pickup. If we look at only the quarter, the third quarter of the financial year, October to December, and we look at the split between individuals and non-individual loans, the split would be 80% of the growth has been on individual loans and 20% of the growth has been on non-individual loans. So we have seen some pickup, and we keep our fingers crossed that that kind of growth continues into the future quarters. Moving straight to the P&L account, on a post-tax basis, this is post-tax, post-deferred tax. We continue to believe that there will never be a liability in respect of the deferred tax provision that we create, but because of regulatory requirement, we are creating that provision. So in this quarter, we have provided 94 crores of rupees towards provision on deferred tax liability. So on a post-tax, post-deferred tax basis, the 9th monthly profit stood at 4,486 crores. I'm only giving you standalone numbers. I'll talk about consolidated a little later. So 4,486 crores was the 9 monthly post-tax profit. which compares to 4,128 crores in the previous year's 9-month period, giving an increase of 9%. If we look only at the third quarter of the financial year, October to December, on a post-tax, post-deferred tax basis, the profits stood at 1,521 crores of rupees, which compares to 1,425 crores in the previous year's third quarter, giving an increase of 7%. Now, if you see the 7% growth in the profits is lower than the on-balance sheet growth in the total loan book of 13%. Now, there are certain reasons for that, and I think it's important to understand what those reasons are. The first reason is that the profit on sale of investments in this quarter has been a lot lesser than what we normally book. Condition of the market and variety of other reasons, so we booked less profit. Even though the absolute unrealized profit in our balance sheet, unrealized profits on listed investments in our balance sheet is actually higher than what it was in September, we have booked less profits. And you reflect profits only when you book the profits, not just based on a mark-to-market of the investment portfolio. So, compared to a profit of 113 crores which was booked in the third quarter of last year, this year we have booked only 57 crores. So, it's half what we had booked last year. Income from leased properties in the third quarter of last year had a one-time income of some 17 odd crores. This time that income is not there, it's citing a 1 crore income, so there's a huge negative on leased properties, which is not again operating business. Provision for contingencies. Now the provision figure is significantly higher this quarter compared to what it used to be in the past. So in this quarter, in the October to December quarter, we have provided 68 crores for provision for contingencies as compared to 45 crores in the third quarter of last year. So that number is up by 50%. The primary reason for the higher provision is, as I mentioned earlier, the fact that the non-individual loan book saw a sharp spurt in growth in this quarter, and particularly in the last couple of weeks of the quarter. And because of the 1,987 crores of additional loans that increase in the loan book on non-individuals, the standard asset provisioning, this is not provisioning for non-performing loans, this is just provisioning for standard assets, has increased by 20 crores. So out of 68 crores, 20 crores is only in respect of these loans generated in December. The total provision for standard assets out of that 68 crores is as high as 54 crores. On NPLs, the provision requirement was only 14 crores. But on standard assets, because of the growth in the balance sheet, the provisioning requirement was a lot higher, and therefore the overall provision for contingencies is much higher this year compared to what it was in the previous year. Another fact which we had explained when we were talking of the September results was the impact that lower interest rates has on our profits. Now, very roughly speaking, very simplistically, if we were to look at the balance sheet, we have about 37,000 crores of shareholders' funds plus provisions, which effectively is reflected in cash. So we have 37,000 crores of funds there, and the rest of our balance sheet, 2.5 lakh crores, is borrowings. As far as borrowings are concerned, interest rates have come down in the course of the quarter, and our lending rates have also come down, and the spreads have been more or less maintained. So our spreads in the 9-month period stood at 2.31%, which was broadly in line with 2.32%, which is what we had in September. So spreads have been maintained. Because interest cost has come down, borrowing cost has come down, lending rates have come down. But on the 37,000 crores of shareholders' funds that we carry, there is no cost, and therefore when interest rates come down, the cost doesn't come down because there never was a cost. But the return we earn, the income we earn on that 37,000 crores will reflect the current interest rates. And if we were to do a daily averaging of interest rates in this quarter, it's about 100 basis points lower than what it was in the previous year. So if you take into account 100 basis points lower interest earning in the quarter on the shareholders' funds, it has an impact of about 95 to 100 crores in the quarterly numbers. So if you adjust for all these facts, if you adjust for profit on sale of investments being lower this quarter, if you adjust for income from leased properties, other income, all of that being lower this quarter, if you adjust for the impact of lower interest rates, then the profit growth for the quarter would have been in line with the growth, in fact, would have been slightly higher than the growth than the on-balance sheet growth in the loan book. So the on-balance sheet growth in the loan book would have been 13%, as I mentioned earlier, and the profits adjusted for all these one-off kind of items would have been 15%. Net interest income. Again, net interest income is calculated differently by different people, but when we talk of net interest income, we take into account all the interest that we earn minus all the interest that we pay plus the fees that we receive, which is nothing but the form of interest. So net interest income for this 9-month period stood at 6,447 crores of rupees, which compares to 5,835 crores in the previous year's 9 months, giving an increase of 10%. If we were to look at only the quarter, then the net interest income for the quarter stood at 2,255 crores of rupees, which compares to 2,068 crores in the third quarter of last year, giving an increase of 9%. But again, this 9% does not take into account the lower interest rates in the economy, which is what I explained earlier. So if we adjust for that 95 to 100, or say even if you adjust for 95 crores of lower interest earning on shareholders' funds, then the net interest income for the quarter would have been about 2,350 crores, which would have represented an increase of about 14%, as compared to a 13% growth in the on-balance sheet loan book. Spread, I mentioned earlier, spreads are broadly stable. Spreads in September stood at 2.32%, spreads in December stand at 2.31%. If we break those spreads between individuals, non-individuals, individual spreads stand at 1.97% and non-individual spreads stand at 3.09%. So clearly, as we've always said, we earn a higher income on non-individual loans versus individual loans, but the risk weight on non-individual loans is greater. The amount of capital we need to provide on non-individual loans is higher based on regulation, and obviously the risk is higher. So if we adjust for asset quality, adjust for risk, adjust for capital, and adjust for all of that, our sense is that the return on equity in both businesses is the same. But pure accounting profit, which is what you see when you look at the P&L account, will always be higher in a period when non-individual business grows faster compared to a period when non-individual business grows slower. Net interest margins stood at 3.85% compared to 3.93% in the previous year, which reflects the 8 basis points lower net interest margin, reflects higher leverage. As leverage in the balance sheet increases, net interest margin will always come down, and secondly, it reflects the lower interest rates in the economy, because of which the earnings on shareholders' funds will be slightly lower. Non-performing loans, broadly the same as they were last quarter. Gross non-performing loan number stands at 72 basis points, fully provided for. Of that 72 basis points, 54 basis points is in respect of individual loans, and non-individual loans carry a gross non-performing loan number of 1.12%. Provisioning, we carry a total provision of 2,186 crores in our balance sheet. This is cumulative provision. As against that 2,186 crores, from a regulatory perspective, we are required to carry only a provision of 1,865 crores. So historically, we've always provided higher than what the regulations required us to provide. If we break up that regulatory provision requirement of 1,865 crores between provision for non-performing loans and provisioning for standard assets, you will see that the bulk of the provisioning is because of provisioning on standard assets, where there is no default, there is no NPLs, but because the loan book has gone higher, we have to make a provision on standard assets. So out of the 1,865 crores of regulatory provision, the provision we carry on standard assets is 1,333.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.